In early February of 2026, the Ethereum market didn't just have a bad week, it completely fell off a cliff. We're talking about a violent, super fast plunge that just erased billions of dollars in a matter of days. So what on earth happened? Well, in this explainer, we're going to pull back the curtain and look at the perfect storm of factors that came together to cause this massive crash. So here's the big question, right? How does something like Ethereum lose over a third of its entire value in a single week? It wasn't just one thing. It was a whole bunch of powerful forces that all slammed into the market at the exact same time. But before we get into the why, let's just take a moment to understand the sheer scale of the damage. First off, the money. Just wow. The crash vaporized around $300 billion from Ethereum's market cap. I mean, that's not just a dip. That is an absolutely astronomical sum of value that was just gone in a few short days. It really puts the severity of this sell-off into perspective. And, behind those huge abstract numbers, there are actual people. Across the entire crypto market, something like 335,000 individual traders got completely wiped out. Their positions were forcibly closed. So this wasn't just numbers flashing on a screen. For a lot of folks, this was a widespread financial gut punch. And this is the number that everybody's eyes were glued to. At its worst, the price of Ethereum cratered, hitting a low of $1,850 on February 6th. Now, just to give you some context, it had been trading comfortably around $2,800 only a week before. So what was the engine that drove this incredible collapse? Okay, let's dive into the core of it. The main driver, the absolute engine of this crash, was a massive deleveraging event. It got nicknamed Black Sunday 2 almost immediately. On February 1st, the futures market went through this incredibly violent purge of borrowed money, and that kicked off the cascade we're about to break down. To really get this, though, we first need to talk about liquidations. So when you hear traders talk about using leverage, they're basically borrowing money to make their bets bigger. It magnifies their potential gains, but it also magnifies their risk big time. Say you use 20x leverage. That means a tiny 5% price move against you is enough to wipe out your entire position. And that forced closure, when the exchange automatically shuts you down, that's a liquidation. And that's what turned a simple price dip into an absolute disaster. And this is where things get really, really messy. It's a domino effect. It starts with just a small price drop, but that drop is enough to trigger the first wave of liquidations for the most over-leveraged traders. Now, here's the key. Those liquidations are forced sells. The exchange just dumps their assets on the market, which, of course, pushes the price down even more. And that lower price, well, that triggers the next wave of liquidations. It's a vicious, self-reinforcing downward spiral. And this chart, wow, it just lays the carnage bare. On that one day, February 1st, out of $2.2 billion in total liquidations across all of crypto, Ethereum was front and center. It made up the biggest piece of the pie, with $961 million in ETH positions just gone. And here's the kicker. Something like 80 to 85% of those were long positions, people betting the price would go up. The market was just incredibly bullish and leveraged to the absolute hilt. It was the perfect setup for a purge. A market that leveraged is basically a house of cards. All it needs is one good gust of wind to knock the whole thing over. And that first gust, it came from a big reversal in institutional sentiment. The same big money players that had been propping up the market, well, they were suddenly stampeding for the exits. Those recently approved spot Ethereum ETFs were a huge story, right? They were bringing billions of fresh institutional dollars into the market. But as you can see right here, that beautiful trend slammed into reverse. After peaking in mid-January, the total money in these ETFs started to fall. That means more money was leaving than was coming in. A huge pillar of price support was literally being yanked away. And just to put a really fine point on it, look at this. On February 4th, right in the thick of the crash, you could see the biggest players in the game actively selling. BlackRock's and Fidelity's ETFs, just those two, saw nearly $80 million get pulled out in a single day. So this wasn't just a lack of new buyers anymore. This was active, large-scale selling pressure from the very institutions everyone was counting on. Now, as all this was happening, you have to remember, the crypto market does not exist in a vacuum. At the same time leverage was blowing up and institutions were getting cold feet, the bigger global economic picture was starting to look pretty ugly for anything considered a high-risk asset. and that definitely includes Ethereum. Basically, investors everywhere were getting nervous. They were in what we call a risk-off mood. You had the Federal Reserve signaling that high interest rates were here to stay, which makes safer investments look way more attractive. You had a stronger US dollar, sell-offs in tech stocks spilling over. It was just a hostile environment for anything volatile or speculative. People were running for safety, not diving into risk. So you've got this shaky, leveraged market. Institutions are selling, the macro environment is terrible. And now for the final ingredient in this perfect storm, fear. Pure, simple fear. And with the market already on edge, news about Ethereum's own founder, Vitalik Buterin, selling some of his holdings, well, that was like throwing gasoline on a raging fire. This was the narrative that just ripped through social media, through news sites everywhere. The perception was that the captain was abandoning the ship, the founder himself was losing faith and panic selling into a crashing market. For a lot of people, that was the ultimate red flag, the ultimate bearish signal, and it triggered a huge wave of pure fear-based selling. But was that what was actually going on? Well, the on-chain data, the real evidence, tells a very different story. These sales weren't some new, panicked move. They were part of a long-standing, publicly announced plan to make charitable donations and fund public goods. The sales themselves were structured to have as little market impact as possible. And the total amount? It was a tiny drop in the bucket compared to the billions traded every day. So the scary perception was completely disconnected from the much more boring reality. Okay, so let's put all the pieces together. What do you get? You have this fragile market just primed for a fall with insane amounts of leverage. Then you have the institutional conviction, the ETF money reversing course. At the same time, you have this hostile macroeconomic backdrop. And finally, you add a spark of fear and misunderstanding. Separately, any one of these is a headwind, but all of them, together, that's how you get a perfect storm. Ultimately, this crash wasn't about just one thing. It was about these four distinct forces all slamming into the market at the exact same time. The leverage was the powder keg, just waiting, and the combination of the ETF outflows, the macro pressure, and that spark of fear around Vitalik, that was the match. It was, in every sense of the phrase, a perfect storm. And all of this leaves us with one final, really provocative question. Are these kinds of violent deleveraging events a fatal flaw in the crypto markets, proof that they're fundamentally broken? Or are they actually a necessary, even if incredibly painful, purge of all the excess and greed that cleanses the system and sets the stage for the next, healthier cycle of growth? That's really the debate that continues to define this entire space.